I have the dubious pleasure to have been in deciding positions in the financial sector since 2010. This is probably too long, but that gives me the privilege to have the possibility to look back and see that over the recent years we've been in reality focusing mainly on post-crisis, on crisis mitigation, regulation, and trying to make our system more stable and more resilient. But it's not for me to judge whether it was successful or not. It was successful to some extent, and of course not completely successful. There's a number of things I personally would have liked to do we couldn't do. There's probably a number of things I wouldn't have liked to do and other people think we should have done. It's a discussion we should have at some point, a post-mortem on the crisis regulation. But the thing is, while some people think we are out of the crisis, some people think we're not out of the crisis. I think I belong to the latter school. Anyway, the peak of the crisis, or this crisis, is behind us, and we're in a better place today than we were in 2010 when I arrived in this environment. We have improved market conditions, we have better capitalized and more resilient banks, and we have higher customers' expectations as well. And meanwhile, the world around us is moving. The financial sector within and outside of the EU therefore faces a number of new challenges, and one of these is the one you've just been discussed, technology. The combination of finance and technology is something really powerful and really scary also, to some extent. It opens a wide area of opportunities, and it also opens a wide area of risks, some of which are really global risks and systemic risks. But other global challenges are also facing finance. Climate change, for example, and more generally, sustainability. In all the meanings of the word, sustainability is, I think, an issue that regulators ought to tackle, or at least they ought to ask themselves how to tackle it. And these issues cannot be addressed by smaller scale actions. I mean, the right scale to address these issues is global, and this is actually why we tackle them in the Financial Stability Board. Because as soon as you have a hole in the net anywhere in the world, the potential from that little hole to address to become the pole of attraction of huge businesses is very, very big. So we need coordinated action at European level, but Europe is too small at global level to face all these challenges. To ensure that our financial system can safely withstand any future crisis, to unlock additional financing for investment, we also have to adapt our regulatory approach. We have to move both to be able to face these challenges and to be able to grab the growth potential that they include. We need to be able to move from curing to embracing the future. So we need to move to the post-crisis regulatory mode without throwing everything away, because of course, if we're back to the good old days of before the 2007 crisis, we'll likely have the same bubble developing, or other bubbles elsewhere in the system, probably not exactly the same one, actually, and we will soon face another crisis. Sustainability is in order here as well. But in a nutshell, from a time where we had to restore confidence in the EU financial system, we should now focus on how to unleash the full potential of the EU financial sector while continuing to preserve financial stability and the market integrity. So our regulatory approach is entering a new phase. Over the recent years, we have put in place measures to ensure orderly markets, to increase transparency, to protect investors. We have tried in a very comprehensive overhaul of the financial regulatory framework in Europe to address not only the root causes of the crisis, but also all other possible causes of the crisis. I've been educated by past experience that shows that you usually cure the root causes of that crisis, and of course the next crisis is never the same one. We believe we provided, as I said, a mix of right and wrong responses, but that globally we're today in a better place. But when you do this, and you have to understand that means when you do between 40 and 50 legislation, which is by European standard is huge, in 4 years. And these legislations, of course, you all specialists financial market. Financial market is a world of numerous interactions. When you deal with asset management, well, you may do exactly the right thing for asset management if you consider asset management alone, but you impact insurance, you impact banking, you impact many other things. And basically, if you center your analysis on any of the activities of financial markets, you will be able to map a number of interactions in many ways to the rest of financial activities. So if you repeat 40 times this analysis, I leave those of you that are good in math to master how many interactions you have, but many. And the chances that you have calibrated all this and mapped them precisely right are exactly 0. So we're bound to have made mistakes. In order to try to address this, we did something that we labeled the call for evidence. And the call for evidence was a call to the market as we were entering into implementation, some of the rules being implemented, some others being on the verge of being implemented. And we told the market, well, we want to know what doesn't work. We don't want to know what you think doesn't work, because that we know already. You lobbied us when we were producing the rule. We want to know, based on evidence, which are the negative lateral interactions that we didn't map, because on paper we couldn't map them, we're not smart enough. But now that we put it in place, they appear. And we want also to know how material they are, because we will fix only those that are really material. For the rest is inconvenient, but tough luck. We believe that the market value of having a stable framework is higher than the value of fixing small, relatively non-material negative interaction. And I have to say we had surprisingly few answers, and some of them very valuable, but we had a lot of, as I said in numerous speeches, we called for evidence and we got pleas. So it was light in evidence, but in some cases it was very precise and very heavy in evidence, actually, and we fixed the issue. But for the rest, we think that framework should stay in place for sufficient time for the market to be able to colonize it. I mean, if you want, one of the problems we have in Europe is the lack of long-term investment. If you want market participants to invest long-term, you need not to change the rules of the game every other day. So that's the plan. The plan is these 40-something regulations, they're there, and they're very unlikely to be massively changed in the foreseeable future. Talking of the future, another issue we face and another topic that keeps us busy in FISMA is, should we continue, I mean, what's the right mix between detailed rules, because you want to know that you guys are very smart, so each time you make a rules, there's this dialectic between the burglars and the policemen. You're always one step ahead of us. So if we make big, all-encompassing, very sophisticated rules, you normally have the best lawyers, the best economists, the best mathematicians. You will find a loophole. So, and also we have a sort of feeling of fixed certainty. We feel safe because we have this big cathedral. It looks very sturdy, but in reality, you have small loopholes that, as I said previously, attract massive businesses. Is this the right way to do legislation? This is the way we've been doing legislation so far. And it has a number of disadvantages. Well, first of all, the one I just mentioned, but secondly, it's not adaptable. If you take about technology, for example, you're bound to lag behind. But even if you don't talk about technology, I have been negotiated for 4 years with the United States, what we call an equivalence for clearing. And in the end of the day, we solved every issue but margining policies. Well, we have a difference. I mean, 2 days net versus 1 day gross. That's not terribly important. One standard is not clearly superior to the other. They're simply different, and they have their own advantages, disadvantages, each of them. But of course, it would have been nice if we had the same, because collectively, the US and Europe will represent 80% of all world transactions. So the efficiencies for the market would have been huge. We couldn't agree on a single standard. But if we had, and assuming that standard would have been different from the current US one and different also from the current EU one, it would have been sufficient for Mr. Giancarlo, at this time Mr. Massad, the head of CFTC, to gather his 4 fellow commissioners and say, well, listen, guys, we have a deal with the EU, so we move from this standard to that standard. Do you agree? Yes, done. I would have had to draft a legislation and submit it to the Council and the Parliament. And we would have negotiated it for 2 years. And maybe in the end, we would have had something else than when I agreed initially with CFTC. Because, of course, it's the God-given right of legislators to do the legislation they want to do. So, and why is it that we're doing this? Well, simply because we don't entrust the institutions that we create, or supervisors, for example, or European supervisors, with the discretion and the flexibility and the power to decide precisely on the things for which we have established them. We want to keep control. And I say we, I say the Commission, the Council, the Parliament. And the result of this is an insane level of detail in what we call level 1 legislation, which is good and bad because that impacts very severely our ability to flexibly follow market. I think it was a problem for Europe to work like this. Well, our complexity is a handicap in many fields, in this one as well. I think it will be very difficult to sustain this handicap in the era where technology meets finance, because things are moving a lot faster. Let me make a couple of points on the topics you discussed today. First of all, yes, we should move forward. Yes, we should move to forward-looking regulation, embracing the future, but there's still a couple of things that needs to be done to finish the repair work. For example, we need to finish banking union. Banking union, as you know, is a massive leap that member states only consented to because they were dead scared in 2011. They actually asked the Commission to do what they had refused to do in 2010, which is to create a single supervisor, a single system for bank resolution, a single deposit guarantee scheme with a single backstop. Single supervisor was created very quickly. Single resolution is now created and works. Single DGS. Well, in the meantime, thanks to a number of things, including these measures, things are going better. So people are less scared. So they start to think, why should we agree to give to the European level these powers? Because it goes fine. Well, so we have two alternatives, basically. Either we think it goes fine, we wait for the next crisis to recall us that it doesn't go that fine, and we do it in an emergency as we did last time, or we try to do it at ease, in peacetime, and build it gradually. That would be my preference. This is what we're busy doing, and this is what we've been discussing this morning with the ministers in the ECOFIN. How do we complete banking union, which means how do we move gradually to a single deposit guarantee scheme, and how do we move gradually to a single backstop, which means the sovereign of the Eurozone collectively backstop the banking system. If we move there, we will move to a situation that is much more like the US. So what is a big bank today compared to, I don't know, the Netherlands GDP will become an average bank compared to the Eurozone GDP tomorrow, and that will be the right comparison to make. Of course, banking union is very important, but banking union doesn't do away with the fact that in 2007, when the crisis started, the continent, so I'm carving out the islands without carving out themselves for a large part of it anyway, but on the continent, we were reliant for around 70% of the financing of our economy on banks. And when I say banks, I mean credit financing. That's a lot. Now you say, well, okay, but it's not so bad because 30% is capital finance. True. Well, now look what were these 30%. 70% of these 30% were big issuances of corporate bonds. Intermediated by whom? Banks. So the truth is, we were reliant on banks for 90% of the financing of our economy, one way or the other. There's nothing wrong with this, except when you have a banking crisis. Because then, of course, if you walk on only one leg, if that leg has a problem, you don't walk at all. And that's part of the problem that the EU experienced, and that's the very first reason why, on top of stabilizing our banking sector and making it more resilient, we need to develop capital financing. And this is a project that we call Capital Market Union. And you talked about it with my friend Paulina earlier today. So Capital Market Union is about having more resilience, because we want to walk on two legs. It is not only this, it's also about having more funding for the economy. Because of course, when we stabilize the banking sector, we kept the engine. There's not much, the way to stabilize a banking engine is very simple. You kept it. So you deleverage. And this is what we did. At the end of the day, you can take all of the measures we took, they boil down to this. And that was the right thing to do. But of course, then the capacity of that engine to produce massively more financing is impaired. So what we don't want the banking system to produce less financing for the economy. But we know that they will not be able, under current conditions, to produce massively more. So the more financing that will help us financing the long-term investment we need in Europe to higher our potential growth will have to come from another source, and that source are capital markets. Why? Well, because at the same time, we in Europe save more than we have ever saved. We're sat on massive amounts of cash for several reasons. Crisis. People save in crisis time because they feel they're fearful of the future. Also because we're aging. So we're saving for old age. But these massive amounts of cash have a huge appetite for liquidity. Which, if you think about it, is strange, because if you save for your old age, you want to have a long-term return. Maybe not huge, but very safe. So you should not be invested in very short-term uses. On the other hand, we have a lot of investment needs. But these investment possibilities and these investment needs never meet. So that is because the intermediation channels are not there. Or they're impaired, or they're purely national, because some countries are doing massively better than others. There are a number of reasons why they're not there. And Capital Market Union is about trying to fix that market failure. And finally, we need to fix that market failure because we need also more adequate funding. We need more, but more is not enough. Not all funding needs of companies are better served by a bank loan. If I'm a young startup, I'm better served by equity. And equity is scarce in Europe. Specifically, equity for startups, equity for SMEs, equity for young companies. Equity for big corporates is okay. But equity for 21.9 million out of the 22 million of companies in Europe is scarce and difficult to find. And that is an issue that is very homogeneously dispersed on the territory. It's difficult to find in Greece and it's difficult to find in Germany. It's difficult to find in France and difficult to find in Sweden. You have little pockets in which is comparatively more easy. It is, of course, more easy in the UK. It's more easy probably also in Ireland. It's a bit more easy in France because it's the biggest capital market on the continent. And then in pockets in Amsterdam, it's more easy than in other places, for example. But that's not at the right size for what we need to achieve in Europe. So Capital Market Union is about all this. And this is the next challenge that we face. We need, as we put it, to repair the funding escalator. So we need a system that works from inception to big corporate. And for this, you need to have the right toolkit. You need also to manage the interactions at border. So you need to have a single market. We don't have that for the time being. And something that is specifically important for me, you need to have a system that allows you not only to have the right toolkit, but the toolkit is static. So, of course, you need to be able to assemble the right financing mix for a young startup in biotech. But what when this startup is successful and needs to grow, and it needs to go international, and it needs to go on a small cap, for example? Well, what we know is that the areas of fragility in the life of any company are the areas of transition, when you have to transit from one financing mix to the other. And for as much as we're bad, but not that bad, in having the right toolkit to assemble the right financing mix, we're very bad at managing the transitions. This is where, for example, the Americans are a lot better than we are. That's a question of soft skills. It's not so much a question of adding regulations, et cetera, et cetera. It's a question of mindset. It's a question of having the right people with the right expertise in order to accompany these companies in their transition. Last, and by means of transition, Capital Market Union is, of course, deeply impacted by technological change. I think, people tell me, oh, Capital Market Union, do you want to emulate the American success? Well, the American market, if I remember correctly, is 5 times deeper than the US one, capital market. And I often say no. I don't think we can, and I don't think we should. Because the reason why the capital markets in the US are the way they are is because of the way the US have chosen to finance the social model. I can tell you, I think that if the Commission goes out and the spokesperson of the Commission says, well, listen, dear European citizens, I have great news. We have decided to move to an American-like social model. You may guess about the chances of success, but I can tell you, in the Nordic countries, no way. In Mitteleuropa, no way. In my country, France, no way. Maybe in the UK, but that's mildly relevant these days. So for most of the countries in Europe, that's not an alternative citizens are ready to swallow. They like the European way, to the extent it exists, of financing the social model. It's more rigid, it's more costly, it's more safe as well, but they like it. Well, the good news is that before you hit the tension between the two, you have a wide margin in which you can better capital financing in Europe. So that's not the real issue. But we shouldn't target the US. The US are the US, and they have a number of other characteristics that explain why they are what they are in financial terms. We shouldn't try to replicate this. I don't think we would be successful. I told you that the problem is the interaction. The problem are the channels that intermediate. Because either they don't exist, or they're broken, or they work in some member states, don't work in others. Private placement works great in France, Germany, UK, and in each of these three countries with a completely different model. It doesn't work basically elsewhere to a significant extent. Why? That's one of the things we're trying to understand. But the things that the study of facts tell you is that there is not one size fits all, because German model, the French model, the UK model are as different as it can be, and the three of them works. So that suggests what you should offer to the member states is a choice of ways of reaching the end and help them towards this, which we're trying to do by supporting them, in particular small member states, to build local ecosystems. FinTech is impacting capital market union. I like to take an analogy that says every analogy is great, but is not really true, but still it gives an idea. You know, if you go, or if you had gone to Africa 15 years ago, very difficult to find a telephone, because it's a nightmare outside of big cities to deploy land lines for fixed telephony. Now, if you go to Africa, you'll be surprised, or if you actually go to Latin America, it's the same. You're in the middle of nowhere, in the middle of the bush or the jungle, whatever. Your phone rings. You have 4G, you can surf on the internet, watch a video, whatever. Surprising. Why? Because they use technology to they jumped over a generation. The result is the same. You have connectivity, but you have it directly through this. Much more efficient. I think partly, for some of the intermediation that we need to build, we can do the same in financial markets. We should not try to emulate what others have been doing with the old technologies. We should try to think in the new world with the new technology. How can we jump over what has been done, do things in a more cost-effective way and more quickly? I think that's for some of the financing intermediation channels, this is probably the most effective way to achieve capital market union. Financial technology in finance is an area that we could spend several days on it. It poses huge challenges to regulators. And it is, in the end of the day, about finding the right balance between allowing, if not promoting, innovation, and still ensuring that your investors and consumers are protected, while avoiding to have massive, potentially going forward, financial stability issues because of cyber breach. So cybersecurity, investor and consumer protection, all this while allowing innovation, so not subjecting these young companies, very mobile, very small, to a whole lot of very heavy regulation that kills them in a minute. That's the issue. And that's difficult. That's complicated. Some jurisdictions find the solution by simply not regulating them. That's probably fine in terms of promoting innovation, and that's probably not fine in terms of protecting market integrity and financial stability. Some others are tempted to subject them to mainstream regulation in the name of technological neutrality. That's, you achieve the other, well, you're very, very safe because they're all dead, so you have no problem. And of course, most of us are trying to find the path in between. with things that go from innovation hubs to sandboxes, and how to connect the sandboxes together, how to cooperate in order to best reconcile safety and innovation. This is what we are trying to do. We have launched a big consultation. We will produce, in the beginning of next year, an ambitious fintech action plan. And we will start by tackling issues that have to do with crowdfunding. What is interesting is that those that are requiring EU regulation are the fintechs. It looks counterintuitive, and the reason for this is that they need market access. So, because if you do not have an EU regulation, you're a fintech, you may be safely in your, say, Belgian sandbox. Well, there is no Belgian sandbox, but assume there is one. Okay, fine, you're relatively successful. You need to address a bigger customer base than Belgium. You're stuck. You're in a Belgium-only regime. So we need to find a way, first of all, that our member states all have sandboxes that are based on the same principle, so to make them interoperable. And secondly, to promote, probably in one of the ESAs, probably ESMA in that case, interoperability on the ground. So that if I'm now too big for Belgium, but too small to sustain the full EU regulation, I can address Belgium and France, because I will connect the French and the Belgian sandboxes. I have shared information with the French supervisor in advance. They understand the business model. They agree to open the market to that sandbox, and it becomes co-supervised in a joint sandbox. For example, this is the type of things that we are looking for. I will finish with something that is, in my view, just as important and is also keeping us extremely busy, and that sustainability. There as well, I mean, sustainable finance, for sustainable finance, fintech is an opportunity if we are able to use it in the right way. But sustainable finance is important because we crucially need to reach the Paris goals, the COP21 goals. Climate is a negative externality, and I've always thought that one of the key features of regulation is to help internalize negative externalities. Is to give a cost for economic actors to something that is a cost for society in the long term, but they cannot appropriate as a cost in their profit-maximizing strategy in the short term. This is what, partly at least, we are trying to achieve in working on sustainable finance. But sustainability is many other things, of course, than climate. But climate's probably, first of all, the most documented, and secondly, the most urgent thing to tackle. On this as well, we plan to have a very ambitious action plan in the beginning of the year. And one of the things I would like us to do is to mainstream sustainability in all the fields of the regulatory framework, so that it can be integrated by market participants in insurance, in banking, in market finance, in their strategies. And by trying to maximize their individual profit, they also do a bit of greater good for the planet. Thank you very much, and enjoy the rest of the day.